The headline price is lying and the spread is telling the truth. And that S, why this rotation into precious metals is about to get a lot louder than people expect. Everyone's staring at the shiny number on the screen, acting like this is just another risk-off day, while the plumbing underneath is flashing stress, constraint, and forced behavior. And if you understand that plumbing, you're not guessing what happens next week, you're rewatching for the exact pressure points where the market has to move, whether it wants to or not. Because the real story isn't gold is up or silver is down. The real story is that risk is getting more expensive to hold, liquidity is thinning at the worst times, and capital is rotating into the few places that can still absorb panic without breaking. And that's where the real pressure starts. Let's get one thing straight. Rotations don't start with a speech. They start with a constraint. Funds don't wake up and say, I feel philosophical today, I'll buy metal. They wake up and say, my risk budget just got cut in half, or my correlations just spiked, or my hedges stopped working the way they're supposed to. And in that moment, money becomes brutally practical. It sells what it has to sell, and it buys what it can buy, what it trusts to hold value when the rest of the screen starts blinking red. That's why the rotation out of risk and into precious metals can look slow, right up until it isn't. Because the first phase is quiet, mechanical de-risking. The second phase is a scramble for hedges. And the third phase is when the market realizes the hedges are also the trade. But that's not the part that matters. Here is the hidden detail that reframes everything. A meaningful chunk of the weird price action you're seeing in precious metals right now is not sentiment. It's calendar-driven, mandatory flow. This is the part mainstream commentary either misses or pretends doesn't exist because it is not sexy. In January, a lot of big money is forced to rebalance, forced to roll, forced to realign exposures, sometimes for tax reasons, sometimes for index mechanics, sometimes because their own mandates reset at the start of a new year. And when that forced flow hits a market like silver, which is smaller, more levered, and more sensitive to liquidity gaps, you can get moves that look like betrayal. A sudden dump, a sharp wick, a nasty open, and the crowd reads it as the story is over. But it's often just the market clearing a forced seller window. And when that window passes, the same setup can snap back hard because the underlying bid never left. It just couldn't show itself while the forced flow was bulldozing through the order book. The next detail is what flips the whole setup. When capital rotates out of risk, you don't see it first in a friendly, well-behaved chart pattern. You see it first in what it costs to hedge, options premiums, volatility term structures, skew, the price of insurance. That is the earliest alarm bell because professional money doesn't wait for confirmation candles to protect a book. It buys protection when protection is still cheap, and it buys it fast. And when that happens, dealers, the ones selling that protection, don't just sit there and hope. They hedge. They dynamically hedge. That's where the reflexivity comes in. Because if the market starts leaning risk off and protection demand rises, dealers can become forced buyers of the very assets that benefit from risk off, simply to stay neutral. That's not conspiracy. That's risk management. It's math. And if this one level breaks, the math changes. Now zoom in on the current price context because it matters for behavior. Gold has been hovering around the mid-4,000s per ounce, roughly in the $4,500 to $4,600 neighborhood recently, after a sharp early month push that got everyone's attention. Silver, meanwhile, has been whipping around the high double digits per ounce, ripping from the low 70s earlier in the month into the 90s area, with violent swings that can make even seasoned traders feel seasick. And here is what was important about that. When a market makes a big move in a short time, it doesn't just change the chart, it changes the rules of engagement. Leverage gets cut, margins get raised, position sizes get reduced, weak hands get forced out. And in the middle of that, the price can look like it's failing, even while the underlying pressure is building. But that's not the part that matters. The reason precious metals become the default parking lot in a de-risking regime is not nostalgia, it's structure. In a real risk-off wave, correlations do this nasty thing where everything starts moving together, and the things you thought were diversifiers suddenly behave like the same trade. That's when portfolios blow up. Not because you were wrong, but because you were too confident in diversification that only exists during calm weather. When correlations spike, the portfolio's effective risk is higher than you think. That triggers selling. Some of it is discretionary. A lot of it is systematic. Risk parity models, volatility targeting funds, CTAs, any strategy that scales exposure based on realized volatility, these strategies don't think. They respond. And when realized volatility jumps, they cut exposure. That means they sell equities, they sell high beta credit, they sell the stuff that was working, and they rotate into what stabilizes the book. Sometimes that's cash. Sometimes that's short duration. And very often it's gold. Because gold isn't just a commodity. It is a monetary asset with a liquidity footprint that institutional money recognizes when it needs a hedge that won't evaporate in a crisis. And that's where the real pressure starts. But silver is the trickster in this story. Silver is both precious metal and industrial metal, which means it gets pulled in two directions at once. In a clean risk-off panic, silver can get hit first because it's liquid and it's volatile. Funds sell it because they can. They sell it to meet margin calls elsewhere. They sell it because it's sitting on a big profit, and they need to reduce gross exposure quickly. That's why silver can fall even when the thesis is right. And then, this is the key, when the selling is done, silver can rebound faster than gold because the market is smaller, and the positioning can flip from everyone is long and complacent to everyone is flat and scared in a heartbeat. That's how you get the air pockets and the rocket moves. That's how you get the days where silver looks like it's been thrown off a balcony in the morning and then sprints up the stairs by the close. But that's not the part that matters. The part that matters is term structure, because the curve is where the truth leaks out. When you hear people say paper versus physical, you don't need to go full cartoon villain to understand what they mean. Futures markets are built for hedging and price discovery, and they're incredibly efficient until they aren't. Physical markets are built for procurement, logistics, and inventory management. When physical tightness rises, it doesn't always show up immediately in the spot headline. It shows up in availability, it shows up in premiums, it shows up in delivery behavior, and it shows up in the curve. Backwardation, when near-term prices are higher than future prices, can be a signal that immediate supply is more valuable than future supply. Contango, when future prices are higher, can reflect financing costs, storage, and a calmer supply picture. You don't have to memorize definitions. You just have to understand what it forces participants to do. If near-term tightness rises, shorts face more pain, roll costs change, and physical buyers become less patient. And that's where the real pressure starts. Now let's talk about the calendar trigger, because this is not a someday story, it's a this week story. January is a minefield of flow, new year resets, rebalancing, liquidity returning after holiday-thin conditions. And right now, mid-January, on a Friday that lines up with major monthly options, expiration dynamics across markets, you get the kind of environment where the tape can be deceptively quiet while the positioning underneath gets rearranged violently. Options expiration matters because it changes hedging needs, it changes gamma exposure, it changes how dealers are positioned against the crowd. And when big expiries pass, the market can suddenly breathe again. The pressure that was pinning price to a level can release. The hedges that were suppressing movement can get unwound. And the next week often reveals the true direction. Because if this one level breaks, the math changes. This is where we get into the mechanism that people either overcomplicate or totally ignore: dealer hedging and gamma. You don't need a PhD. Here's the clean version. When traders buy call options on gold or silver exposure, the dealer who sold those calls is short gamma, meaning their hedging behavior can amplify moves. If price goes up, they often have to buy more underlying futures to stay hedged. The buying can push price up further, which forces more buying. Reflexivity. On the flip side, if price drops through certain levels where a ton of options are clustered, hedging flows can flip and accelerate downside. That's why levels matter more than vibes. It's also why you can see sudden, brutal dips that look like the market knows something when it's really just hedging flows, ripping through thin liquidity. And that's the part that hunts retail. The dip feels like proof you're wrong, but it's often just the machinery doing what it does. But that's not the part that matters. What matters is that capital is rotating away from fragile narratives and into hard collateral. And hard collateral doesn't mean no volatility, it means different volatility. It means volatility that tends to be driven by real constraints: availability, delivery, hedging needs, macro regime shifts. The macro piece is simple but misunderstood. People love the one-liner. Higher yields are bad for gold. That's only half true, and sometimes it's flat out wrong. The market doesn't care about nominal yields in a vacuum. It cares about real yields, inflation expectations, currency stability, and the credibility of policy. If nominal yields rise because growth is strong and inflation is tame, risk assets can party and gold can chop. But if nominal yields rise because the market is demanding more term premium, more compensation to hold long-duration debt in a world of deficits, geopolitical uncertainty, and policy friction, then higher yields can actually be risk-off. That can tighten financial conditions, pressure equities, and increase the appeal of gold as a monetary hedge. And that's where the real pressure starts. Now you want proof stacking, not a single storyline. So stack it. First proof layer, price behavior itself. Gold's ability to hold elevated levels after a sharp push, even with pullbacks, tells you there's a real bid. Second layer, silver's volatility. It's not just speculators. It's fast. This is the signature of a market where liquidity can comfortably absorb the flow without swinging. Third layer, the curve and spreads. When near-month pricing and roll behavior get jumpy, it's telling you the market is negotiating scarcity and financing in real time. Fourth layer, institutional flows. When risk starts to feel expensive, big money leans into liquid hedges and diversifiers. Gold is always high on that list, and silver often becomes the high-octane version of the same idea once the dust settles. Fifth layer, global context. In an environment where people are questioning the stability of currencies, trade relationships, and reserve composition, gold isn't just a trade, it's a policy asset. You don't need to romanticize it. You just need to respect the incentive, and that's where the real pressure starts. Let's address the paper versus physical tension again, but like adults. Futures prices can move on positioning, liquidity, and hedging. Physical markets move on procurement needs, refinery throughput, shipping lanes, and inventory location. These two worlds are connected by arbitrage, but arbitrage is not magic. Arbitrage requires capital, credit lines, time, and logistics. If the spread says buy here, sell there, someone still has to finance that trade, source the metal, move it, insure it, and deliver it on time. When balance sheets are constrained or when logistics are tight, that bridge gets narrower. The result is that price can lag reality until it doesn't. And when it catches up, it doesn't do it politely. It gaps, it squeezes. It rips through levels that people assumed were strong resistance. Because resistance is just a word for where liquidity was last time. But that's not the part that matters. The key is understanding who gets forced and when. In a de-risking wave, the first forced sellers are usually leveraged longs in risk assets. They get hit by volatility, margin, and correlation spikes. Then, you get forced sellers in anything liquid. They sell winners to cover losers. That's when you sometimes see gold and silver dip alongside equities and people scream, "See? No hedge." That's the trap. Because the second phase is when the forced selling runs out and the hedging demand remains. That's when gold starts acting like gold again. That's when silver flips from ATM liquidity source to high beta hedge. And then, if positioning is wrong, if shorts were leaning on the market expecting mean reversion, you can get a short covering spiral. Shorts cover not because they changed their mind, but because their broker changed the rules. Margin goes up. Volatility rises. Risk managers cut limits. The position becomes toxic. And that's where the real pressure starts. So what do you watch if you want to stop being whipsawed by narrative? You watch behavior around levels. Not because levels are mystical, because levels are where orders cluster. Round numbers matter because humans and algorithms both anchor to them. In gold, think of zones like $4, $500 as a psychological shelf, with $4, $400 beneath as a do not break area for the near-term uptrend thesis. And then upside zones like $4,700 and $4,800 as areas where the market either accelerates or stalls depending on flow. In silver, think of $90 as a battle zone, $85 as the controlled pullback retest zone, and then $95 to $100 as the zone where headlines start chasing the move and volatility turns predatory. These aren't promises, they're pressure points. They're where the market reveals whether demand is real or just momentum tourists, because if this one level breaks, the math changes. Now let's talk counterpoints, because credibility lives here. What could break the rotation into precious metals? 1, a sudden, clean, risk-on melt-up that reduces hedging demand and drags capital back into beta. 2, a sharp and sustained dollar surge that tightens global liquidity and pressures commodity prices broadly. 3, a policy surprise that convinces the market real yields can rise without stress. Basically, a regime where holding cash and duration feels safe again. 4, a meaningful easing of physical tightness signals if spreads calm and availability improves and the curve relaxes. 5, positioning getting too crowded. When everyone is already on the same side of the trade, the market uses volatility to punish late entrants. If you could name these, you're not a cheerleader. You're a risk manager. And in this market, risk management is the edge. But that's not the part that matters. The part that matters is your psychology. Because even if the thesis is right, the market can whip around violently. It can drop 3% in a day and still be in an uptrend. It can spike, reverse, and make you feel stupid on both sides. That's not accidental. Volatility is a tool. It's how the market transfers inventory from impatient hands to patient hands. It's how it forces you to sell the bottom and buy the top. The emotional manipulation is predictable. A sharp drop makes you feel like the thesis is broken. A sharp rally makes you feel like you missed it. A grind makes you bored and sloppy. The antidote is simple: separate trend signal from noise. Trend signal is where price holds key shelves after pullbacks, where dips get bought with urgency, where the curve and spreads don't relax even when spot wobbles. Noise is intraday chaos, headline spikes, and everyone on social media suddenly has a target. If you can't tell the difference, you become liquidity for someone who can, and that's where the real pressure starts. Now bring it back to why now. Because this isn't just a long-term philosophical case for metals. The near-term catalyst is the intersection of calendar flow and risk repricing. Mid-January is where the market stops pretending it's still in holiday mode. Liquidity normalizes, but it's not deep yet, which is the worst combination. Enough participation to create big repositioning, not enough depth to absorb it smoothly. Add options-related positioning and the unwind of forced flows from earlier rolling and rebalancing, and you get the kind of setup where the next 1 to 2 weeks can define the tone for the entire month. If gold holds its shelf through this window, that's a message. If silver stops being used as a cash machine and starts being accumulated on dips, that's a message. If spreads stay tight and the curve stays firm, that's a message. Because if this one level breaks, the math changes. So here's the 2 scenario lens, the one that keeps you sane when the tape starts trying to hypnotize you. Scenario 1 is the controlled pullback and retest. In this scenario, gold and silver breathe. They pull back into support zones, volatility stays elevated but not disorderly, and the market tests whether the new buyers are real. Confirmation looks like shallow dips, quick recoveries, and a refusal to break the do not break levels. Invalidation looks like a clean breakdown that holds, meaning price doesn't just dip below support. It lives there, it closes there, it turns previous support into resistance, and the bids disappear. Scenario 2 is the continuation squeeze. In this scenario, the market doesn't give you a comfortable entry. It grinds higher, breaks a key resistance zone, triggers stops, forces hedging flows, and creates gap risk. Confirmation looks like expansions in range on up days, quick reclaim of any dips, and a general sense that sellers can't find traction. Invalidation looks like a breakout that immediately fails, a hard reversal, and a collapse back into the prior range. 2 movies. That's it. Everything else is noise. And that's where the real pressure starts. Now let me be blunt about what to watch next week, because this is where most people either overtrade or do nothing. Track the curve, the spreads, and the way dips get bought or don't. If the market is truly rotating out of risk and into precious metals, you'll see it in the behavior of the dips. In a weak market, dips are slow, bouncy, and sellers feel comfortable. In a strong market, dips are sharp and get snapped up, almost like someone is waiting with a checklist and a budget. Watch volume and volatility together. Rising volatility with rising price can be a squeeze. Rising volatility with falling price can be liquidation. They feel similar emotionally. They are not the same mechanically. And if you're watching the broader risk complex, equities, credit, the dollar, pay attention to whether the risk-off bid is persistent or just a one-day tantrum. Persistent risk-off is when rallies get sold, hedging stays bid, and correlations keep acting ugly. That's when metals tend to benefit, but that's not the part that matters. The deeper point is that this rotation is not about being bullish metals in a vacuum. It's about recognizing a regime shift in what people trust. When institutions start questioning the stability of growth narratives, when the cost of capital becomes a weapon instead of a tailwind, when geopolitical friction makes supply chains and reserves feel less plug and play, capital looks for assets that are nobody else's liability. That's gold's superpower. Silver's superpower is that it can lag, frustrate, and then explode because it's the thinner market with more torque when positioning flips. That torque is dangerous. It can also be rewarding if you respect it. Respect means position sizing that survives a nasty wick. Respect means not confusing intraday chaos with thesis failure. Respect means having invalidation levels and actually honoring them. Because the market doesn't owe you a smooth ride. It owes you nothing. And that's where the real pressure starts. One more thing, because this is the part that separates people who build wealth from people who build stress. Don T. confuse being right with making money. You can be right on the thesis and still get chopped if you let the market manipulate your timing. That's why the psychology shield matters. Decide what time frame you're operating on. If you're watching the next 1 to 2 weeks, your key job is to avoid getting flushed out by volatility around major flow windows. If you're watching the next few months, your key job is to focus on regime signals. Does gold keep acting like a monetary asset? Does silver stop behaving like a funding source? Does risk keep repricing? Does the curve keep telling you tightness hasn't gone away? If you can't answer those, you're trading headlines. And headlines are designed to steal your attention, not grow your account. But that's not the part that matters. Here's the subtle truth. The market will try to make you feel late right before it moves, and it will try to make you feel wrong right after you enter. That's the game. The only way you win is by staying anchored to mechanisms, not moods. Mechanisms like forced flows and calendar windows, mechanisms like dealer hedging and gamma, mechanisms like short covering under margin pressure, mechanisms like term structure and spreads that reveal tightness, mechanisms like institutional behavior that doesn't chase headlines but does respond to risk budgets. If you can keep your eyes on those, you don't need perfect timing. You need consistency. And consistency is rare. That's why it pays. And that's where the real pressure starts. So if you're asking, What do I do with this information today? You don't need a heroic decision. You need a plan you can execute when the market tries to emotionally hijack you. Know your key zones. In gold, watch whether the market can defend the mid $4,500 area and whether any dip toward the low 4,400s gets bought quickly. If it fails and stays below, that's a warning that the rotation is pausing or that liquidity stress is forcing liquidation. On the upside, a clean push through the next resistance zone in the $4,700 to $4,800 region would signal that the market is transitioning from rotation to chase. In silver, watch whether the market can hold the high 80s on any pullback. If it does and it rebounds fast, you're likely in the controlled retest movie. If it breaks down and can't reclaim, you're in the liquidation movie. On the upside, a firm move through the mid-90s with momentum toward 100 oscillars is where reflexivity and headline chasing can create a squeeze. That squeeze will look obvious in hindsight and feel impossible in real time. That's why you need the plan first. Because if this one level breaks, the math changes. And here's your final reality check. None of this is guaranteed, and none of it needs to be. The goal isn't to predict every tick. The goal is to understand where the market is forced to act. Forced flows end, expiries pass, dealers rebalance, funds reset. And then the tape reveals what was real and what was just mechanical noise. If you're in this community because you care about mechanisms, not memes, then you already have the advantage most people refuse to build. Stay patient. Stay skeptical. Stay keyed into the curve, the spreads, and the way the market behaves when it thinks nobody's watching. Because the headline price will always try to hypnotize you. The plumbing won't. And if you want the rotation's next chapter, it's going to be written in that plumbing this week, not someday.